Hey everybody, Marty Missouri, good morning. Quick commentary for you, I promise, this morning. I was going to offer up something on the blog, and I thought this fastest, easiest way for me to do it, given my schedule this morning. So here's that familiar chart for those of you who have been with me all the way back here in early January. This is a good looking technical setup. The moving averages are sloping in the right direction. The intermediate term, the long term, and the really short term. This cross above the 50 and the 200 by many technicians is considered very bullish. You can see it happened right here as the market began to mount its way closer to all-time highs. My on-balance volume indicator has broken decisively out of the downtrend. It's confirming the recent rally as well. So technically speaking, and I could go on, things actually look pretty good for the market in terms of the underpinnings. Fundamentally, overall, things have gotten a little better. Our economic index has improved the last 2 or 3 weeks. I like that. What I don't like is the news that came out yesterday. I think the market's reacting to that this morning, and that's that the U.S. is proposing about $11 billion worth of tariffs on European goods. I've mentioned over and over and over again herein how it would not be good for the market and absolutely not good for the economy globally or in the US for us to play hardball with Europe after ultimately, I believe, concluding the trade dispute with China. Of course, that trade dispute has to conclude with a reduction or ideally an elimination of all the tit-for-tat tariffs that have been imposed since it began. So the market was a little slow to react to this. Some are saying it's earnings worries. We still have issues around Boeing, which I've written about a little bit herein. But make no mistake, folks, this is by and large about uncertainties over trade. The International Monetary Fund, again, lowered its global economic outlook. And of course, the biggest concern is trade relations throughout the world. So if we continue in the same vein that we have since early 2018, which in my view completely destroyed what was a nice looking market in 2018 in terms of net returns, we will have a replay of that in 2019, only economic conditions are not what they were going into 2018, so it'll be worse than it was ultimately if we continue to go there. That's a big if. The political risk is enormous. At times, like when the market was down here, I liked the rhetoric coming from the administration. Sound like they understood that they need to put an end to this. As the market has improved, more bravado begins to show up, and we begin saying the same things that we were saying aggressively up in here. If we continue with that, folks, I can virtually guarantee you that we will once again see this kind of price action. Then we will once again see a more conciliatory attitude here. The question that I will have to continue to ask myself, and will general conditions continue to hold up? Right now, they're holding up nicely, which is allowing us to keep our cyclical bent in our portfolios. But this is a risk. The market, in terms of the Dow, is down 172 points as I speak. Frankly, I think it would be better if it were down 772 points, because that would wake up the powers that be to the reality that global trade is embedded in the way we and the world operates. The U.S. economy thrives on global trade. If we continue to upset the apple cart and upset global supply chains, we are going to continue to upset the stock market and upset the economy. Folks, that's just frankly how it is. There's nothing political here. We basically just tell it as we see it. Technicals look very good. Fundamentals look very okay. The rhetoric around trade and the headline risk is very big right now. I'll leave it there and I'll keep you posted. Thank you as always for watching and listening, and I'll talk to you again very soon. Bye-bye.